Hey there, folks! Welcome back to another eye-opening episode. Tonight, we're diving deep into the often murky waters of consumer credit. It's a topic that affects nearly everyone, yet remains shrouded in mystery for most. Buckle up, because things are about to get real. We're going to unravel some of the most pervasive myths and misconceptions that have been fed to us for years. When we talk about credit, we often think of banks as these benevolent giants, lending us money out of the goodness of their hearts. They present themselves as our financial saviors, always ready to help in times of need. But what if I told you that this perception is a carefully crafted illusion? Just like a magician's trick, it's designed to make you see what they want you to see, while the real action happens behind the scenes. What if the truth is far more empowering for us, the consumers? Imagine realizing that you hold more power in this financial relationship than you've ever been led to believe. You see, the system relies on a fundamental misunderstanding. This misunderstanding keeps us in a state of dependency and ignorance. We've been led to believe that banks create credit. This belief is so ingrained that we rarely question it. They don't. You do. Every time you sign a loan document or swipe your credit card, you are the one creating credit. Yes, you heard that right. The power to create credit lies with you, not the banks. This is a game changer. You, the average Joe, are the original creditor in the vast majority of financial transactions. This means you have more control and influence than you might think. Don't believe me? Let's unpack this together. We'll break down the complex legal and financial jargon to reveal the truth. This journey will take us through the labyrinthine world of legal frameworks governing consumer credit. It's a maze, but one worth navigating. We'll be exploring the Uniform Commercial Code, the Federal Reserve's regulations, and the Uniform Consumer Credit Code, among others. These are the rules that shape our financial lives. Understanding these codes and regulations is crucial. They hold the keys to unlocking your financial potential and protecting your rights as a consumer. And trust me, it's going to be a wild ride. There will be twists and turns, but the destination is worth it. By the end of it, you'll have a newfound understanding of your role in the financial system and how to use it to your advantage. You'll see the financial world with new eyes. So, grab your thinking caps, folks, and let's expose the truth about consumer credit. Together, we'll lift the veil and reveal the reality behind the credit illusion. First up, we've got the Uniform Commercial Code, or UCC for short. Think of it as the rule book for all things commerce in the United States. It's a big, complicated document, but for our purposes, we're going to focus on one key aspect: negotiable instruments. Now, negotiable instruments sound fancy, but they're really just fancy words for things like checks and promissory notes. These instruments are essentially contracts that represent a promise to pay a certain amount of money. When you sign a promissory note for a loan, guess what? You're creating a negotiable instrument. Here's the kicker. According to the UCC, the very act of creating that promissory note makes you the creditor. You're essentially extending credit to the bank, which then turns around and lends it back to you at a profit. Sneaky, right? But it's all right there in the fine print. Now, let's talk about the Federal Reserve, also known as the Fed. This institution plays a crucial role in the financial system of the United States, and its influence extends globally. Established in 1913, the Federal Reserve was created to provide the country with a safe, flexible, and stable monetary and financial system. They're the big dogs when it comes to monetary policy, making decisions that affect the economy on a grand scale. From setting interest rates to regulating banks, the Fed's actions have far-reaching consequences. And they have a couple of regulations that are particularly relevant to our discussion: Regulation Z, Truth in Lending Act, and Regulation D, Reserve Requirements. These regulations are designed to ensure transparency and stability in the financial system. Regulation Z is all about transparency. It was enacted in 1968 as part of the Consumer Credit Protection Act. The goal was to promote the informed use of consumer credit by requiring disclosures about its terms and cost. It requires lenders to disclose the terms of a loan in a clear and conspicuous manner. This means that borrowers should be able to understand the terms of their loans without needing a law degree. This includes things like the annual percentage rate, APR, finance charges, and total amount repaid. Why is this important? Because it allows consumers to compare different loan offers and make informed decisions. Because it shows that the lender is obligated to provide you with specific information about the credit you're supposedly receiving from them. This transparency helps prevent deceptive and unfair lending practices. It's almost as if they're acknowledging that you're the one calling the shots. You have the power to make an informed decision and the lender must respect that. Then we have Regulation D, which dictates how much money banks need to keep in reserve. This regulation is crucial for maintaining the stability and liquidity of the banking system. This is where things get really interesting. Regulation D sets reserve requirements, which are the amounts of funds that a bank must hold in reserve against specified deposit liabilities. You see, when you take out a loan, the bank isn't actually lending you its own money. Instead, it's creating new money based on your promise to repay the loan. This process is known as fractional reserve banking. It's creating new money out of thin air, using your promissory note as collateral. This newly created money is then added to the money supply, which can have various effects on the economy. And the amount of money they can create is directly tied to the reserve requirements set by the Fed. Higher reserve requirements mean banks can create less new money, while lower requirements allow for more money creation. So, in a way, you're not just the creditor, you're also indirectly influencing the money supply. This intricate dance between regulations, banks, and borrowers is what keeps the financial system ticking. Section 4 UCCC, a unified front for consumer credit. Next up, we have the Uniform Consumer Credit Code, or UCCC. This code is a comprehensive set of laws designed to standardize consumer credit regulations across the United States. It was created to ensure that consumers are treated fairly and consistently no matter which state they live in. Don't worry, we're almost through the acronym jungle. The UCCC is here to simplify things for both consumers and lenders by providing a clear and uniform set of rules. This code aims to standardize consumer credit laws across different states. By doing so, it helps to eliminate confusion and discrepancies that can arise when each state has its own set of regulations. It covers a wide range of topics, including loan agreements, interest rates, and debt collection practices. This means that whether you're taking out a mortgage, a car loan, or a personal loan, the UCCC has guidelines in place to protect you. One of the key features of the UCCC is its focus on consumer protection. It includes provisions that are designed to prevent predatory lending practices. Such as exorbitant interest rates and unfair loan terms. These protections are crucial in ensuring that consumers are not taken advantage of by unscrupulous lenders, such as exorbitant interest rates and unfair loan terms. By setting limits on what lenders can charge, the UCCC helps to create a fairer and more transparent lending environment. This is important because it acknowledges that there's an inherent power imbalance between consumers and creditors. Lenders often have more resources and knowledge which can put consumers at a disadvantage. The UCCC tries to level the playing field by giving consumers certain rights and protections. For example, it requires lenders to provide clear and accurate information about loan terms and conditions, so consumers can make informed decisions. For example, the UCCC gives consumers the right to rescind certain types of loans within a specific time frame. This means that if you change your mind about a loan, you have a limited window to back out without penalty. This provision is particularly useful for consumers who may feel pressured into taking out a loan without fully understanding the terms. It also places limits on the amount of interest and fees that lenders can charge, preventing them from trapping consumers in a cycle of debt. By capping interest rates and fees, the UCCC helps to ensure that loans are affordable and manageable, preventing them from trapping consumers in a cycle of debt. Overall, the UCCC is a powerful tool in promoting fair and equitable lending practices, protecting consumers, and fostering a healthier financial environment for everyone. Section 5. TILA, shining a light on loan terms. Remember Regulation Z, the one that forces lenders to be transparent about loan terms? Well, it has a fancy official name, the Truth in Lending Act, or TILA. This act is all about empowering consumers to make informed decisions about credit. TILA requires lenders to disclose key information about a loan, such as the APR, finance charges, and total payment amount. This information must be provided in a clear and conspicuous manner, so consumers aren't blindsided by hidden fees or confusing terms. But TILA goes beyond just disclosing loan terms. It also gives consumers the right to sue lenders who violate the law. This means that if a lender tries to pull a fast one by hiding fees or misrepresenting the terms of a loan, consumers have legal recourse. TILA is a powerful tool for holding lenders accountable and ensuring fairness in the credit market. Section 6 FDCPA, keeping debt collectors in check. Let's face it, dealing with debt collectors can be a nightmare. They're often relentless, employing aggressive tactics to try and collect on debts. But fear not, because the Fair Debt Collection Practices Act, or FDCPA, is here to save the day. The FDCPA is a federal law that regulates the behavior of debt collectors. It prohibits them from engaging in harassing, abusive, or deceptive practices when attempting to collect a debt. This includes things like calling at unreasonable hours, making threats, or posing as law enforcement officers. But the FDCPA doesn't just protect consumers from bad behavior, it also gives them certain rights. For example, consumers have the right to dispute a debt and request verification. They also have the right to tell a debt collector to stop contacting them, which can be a lifesaver if you're being bombarded with calls and letters. The FDCPA is a crucial piece of legislation that helps to ensure fairness and dignity in the debt collection process.